We are very proud to have Hanna Hałaburda with us. Hanna is a prof at the NYU Stern, and she's going to talk to us about the impossibility of doing things on permissionless blockchains.
Thank you. I am assuming that people here and online are familiar with blockchains, Bitcoin and Ethereum. So specifically, I'm going to talk about decentralized.
They're saying they cannot see the slides.
You cannot see the slides, so let's make sure
I can see the slides.
Let's maybe share, unshare, and we unmuted, right?
Yeah. So some people say they can't see. They can. Okay, let's start.
How many computer scientists does it take to?
Oh, okay, she found it.
Okay. So we are good.
Yeah, we're good.
So I wanted today. I will be talking about trading specifically and trading on permissionless blockchains, because blockchains. Some people say blockchains have to be permissioned to be blockchains. Some say permission blockchains are also blockchains. I'm not going to get into this debate. This is only about permissionless blockchains and this idea of limits to decentralization. And also what I want to say, I'm coming from economics tradition, not computer science tradition, which means that I expect questions to be asked as we go along. If I'm not hearing questions, I worry people don't listen or cannot hear us on Zoom. So both for Zoom and in the room. So with that, starting from blockchain premise, blockchains going back to Bitcoin started with the premise of creating this transparent, decentralized system that will be fair and verifiable. And even in the first, in the abstract of Bitcoin paper, it was all about getting rid of intermediaries, getting rid of this centralized systems that hold power. And instead, the idea was to create a system that would allow for decentralized decision-making and operation in a way like, school of fish has no leaders and they get where they need to get and so on. And this is all about leveling the playing field, making the system fair and removing powerful agents. So this is, and since 2008, we had a number of systems that provided architecture that make it possible. The thing is that making it possible is not enough, because even though we do have this architecture, what we observe in equilibrium, once we account for the economic forces and incentives and competition, we actually end up with quite centralized system in reality. So allowing for the centralized system does not forcing the system, it's not forcing the system to be decentralized. So what we are observing in many blockchains is that some power structures reemerge. We do see recentralization. And the way we can see it is there's concentration of block creation. And we also see rent extraction from trading, and this comes, for example, as MEV. And that has been kind of studied and looked at extensively. So the main idea is that architecture can be decentralized, but it does not prevent the economic equilibrium from becoming centralized. So the question is, what drives this centralization? And maybe when we answer what drives this centralization, we can, down the road, prevent this recentralization and create a system that not only allows for the centralized system to operate as efficiently as possible, but also is going to make sure that the system stays decentralized. So to show this, yeah?
Can you give an example of a system besides blockchains where this happens?
Yeah, so for example, the previous technology that was promising decentralization, democratization, and disintermediation, the internet gave us the most powerful intermediaries that we have seen yet. That kind of happened the same way.
And like anything computer systems, and also like we have a question from the crowd.
So pre-computer system, think about the kind of picture, like the textbook example of democracy, which is Athens, which eventually not degenerated, but evolved into representative democracy and gave us Caesars, right? And also starting from, and still kind of saying it's a democratic system with Senate and voting, except somebody was all powerful at the end after a couple of generations.
And Zhengwei, you can.
All right, thank you. So wondering, like, do you think like transparency in blockchain, it's part of the design goals, or it's kind of the limitation of the design architecture back in the days? So do you think for decentralized architecture, do we have to have transparency, or privacy is also considerable if technology allowed?
So in fact, I do start by saying that the transparency was this premise of blockchains because it was initially, but you're right. I think that transparency was more for the technical ability, or giving us technical ability to verify censorship resistance, verify validity of transactions, and for everybody to be able to verify that. And with zero knowledge proofs, for example, we can have both privacy and verifiability. What I'm going to talk about, so all the mechanisms that I will talk about, transparency is not necessary. So we do see this force, and the forces leading from this decentralized architecture to centralized equilibrium, happening also in environments that do not promise transparency. But transparency gives us a much better view into what is happening. So we probably could not have such a great, examples like this one if it wouldn't be for some level of transparency that we have in blockchains. Does this answer the question?
Yeah, so another question is like on a high level for like I'm not economic background, but for general economic system, is transparency more preferred, or it's that or like some information is not public is also allowable in like even traditional economic system?
So in traditional economic systems, if we look at game theory, games are different if we have perfect information or imperfect information, if we have private information. And it is taken for granted that sometimes there is private information. Of course, it is more difficult to check. It's more difficult to find equilibria with imperfect information. Strategies are more complicated. Now, it does not mean that perfect information, so having full transparency, is always desirable, because privacy concerns are a real thing. And for example, if we think about voting, if we would have complete and transparent information about everybody's preferences, voting would be manipulable. Whereas if there is uncertainty about preferences, then many voting mechanisms are considered non-manipulable or not practically manipulable in restricted information environments. Does this answer your question?
Yes, great, thank you.
Thank you. Because if you're not here, I cannot see the response, facial response. Okay. So going back to the concentration that we observe in practice in blockchains, this is an example from Ethereum. So back in December, but basically maybe sometimes identity of these block builders here changes, but we see pretty similar picture even if we check later. So what we are seeing is that block builders vary in their frequency in which they build blocks. And what is worrying is that we may have one block builder that is building more than half. So this was 49, but sometimes the Titan will have more than 50% of the blocks being built over the past month or so. So this is quite strong concentration. If you think about the promise of decentralized structure and keeping everybody in check, to make sure that nobody in the system misbehaves. Right? So we do see that the small set of block builders captures a vast majority of blocks being created. On top of that, what we are seeing, so this is the kind of concentration. What we are seeing are other sources of power. So, for example, MEV is economically meaningful. Those are hundreds of millions of dollars. That is value that can be extracted from building blocks, and this is why building blocks is so valuable. And what we are seeing as a response market response to this MEV extraction is what we call private order flow channels, and this is when traders are sending their transactions directly to a particular block builder, one or two, but not to the mempool. So that already is defeating transparency, or the idea of transparency. If we thought that transparency is important, some transactions are never showing up in mempool, and they are privately routed to prevent this transparency. Because, so going back to the question, in this case, transparency is actually hurting traders. And this is because of the ability of front running. Okay. So this was an example from Ethereum, and this is kind of surprising to see, or on the face of it, we would think that it's surprising to see this level of centralization, because Ethereum has been following the canonical decentralization playbook right from the beginning. So each major Ethereum design choice was motivated by standard decentralization logic. First, permissionless entry, preventing gatekeeping and exclusion. Everybody can come in. Anybody can create a node. Back during mining times, anybody can become a miner. Anybody can become a staker when staking. Anybody can become a builder, right? So yes, maybe you need some capital investment, but nobody is going to keep you away if you make this investment. Then this public mempool and transparency was supposed to offer fairness, auditability, so that we can see whether some transactions are censored or not, and neutral access, because if I want to become a builder or I want to become a miner, but I don't have access to transactions that Aviv has access to, then it puts me at the worst position, and then it's not neutral. Then moving on to proof of stake was touted as a change in the system that is going to increase decentralization more than proof of work, because proof of work was capital intensive. There was hardware that you needed to invest in, and that could create economies of scale. If you invested in hardware, you were faster, you had more advantage. So proof of stake did, in fact, take away this economies of scale, and everybody was supposed to be on the playing level field. Now, what proof of stake also allowed was the separation between proposer and builder. So proposer is the entity that has a stake and is going to put the block onto the blockchain in a way, but they don't need to build the block themselves. They can take this block from somebody else, in a way, buy it from somebody else at the price. And this was also touted as this great tool of decentralization that is going to promote decentralization, that is going to separate roles. And because of the competition between builders, there was a bizarre logic that it's going to reduce MEV abuse. Because now builders are going to compete, and then the proposer or traders are going to choose the builders that are going to extract less MEV I mean, that doesn't, I mean, I remember having these discussions when builder-proposer separation was proposed, and I said, but just because they are competing, they are not necessarily competing on the dimension that is against MEV extraction. In fact, they are competing on the dimension that is inducing more MEV extraction, but that didn't seem to appeal to people who were introducing it. So what we are seeing, in fact, if you look at the changes that were made, is that after every decentralization update or update that was supposed to provide more decentralization, we see the concentration intensifies when we look at the block building concentration specifically. Okay. So I'm not the first one to look into the study centralization in blockchains, especially in Ethereum. There is already, this is a selection of work. There, oh yeah, so, okay. It's like school of fish. Okay, I must press too many buttons. So first of all, we know that MEV exists and is economically meaningful. What I mentioned, this comes from a number of papers. We already know that block building in Ethereum is highly concentrated, which I showed you a graph, but there is like, more systematic work on that. Exclusive order flow dominates outcomes. Now, right now, 2/3 of transactions that end up in the blockchain, in fact, never show up in mempool. Winners are persistence and builder specific. So winning blocks, it actually keeps you winning and winning in the future. Contest-based block construction can centralize under the builder-proposer separation. Now I don't know how to turn it off, so we'll need to look at it.
Go ahead.
So now,
Zhengwei has a question.
Oh, okay. Question.
Would you mind go back to the previous slide?
Previous slide, yes.
One more.
Yeah.
Yeah, so here you're saying like PBS reduces MEV abuse. Like, why is that? Like, you have another comment.
No, in fact, it doesn't, but it was touted as, so it basically, when it was introduced, there are these two posts by Vitalik Buterin saying that it is going to reduce MEV abuse, that we are introducing the separation to limit the MEV extraction. And this is how it's going to happen. So this was the logic, which in fact is not the correct logic. But the logic was that it is going to increase competition. If builders are going to compete, then presumably the builder that is extracting less MEV value should win. But the mechanism through which this would happen was not clearly explained.
Yeah, it's very confusing. It seems to me like those who can like extract more MEV would win because then they can offer like better deal for the proposers to pick it up.
Yes.
Another question is regarding permissionless. So, for example, for Bitcoin, like it's from the Bitcoin system itself, it can be considered fully permissionless because you can join the network anytime and even becoming the lead the block leader of one of the slots whenever you solve the cryptographic puzzle. But in proof of stake system, basically, if you want to join the system, you need to first have some stake in the beginning. Like for Ethereum, you need to have at least 32 Ethereum to become a proposer. Do you think like so from my understanding, like proof of work from the Bitcoin system itself is fully permissionless, but from the economic perspective, it's not permissionless because you need to have still like substantial amounts of computing power to actually like solve the cryptographic puzzle on time and get into the game and become one of the proposer. But now Ethereum is basically moving that in the new name called stake, and then within its system itself, It sounds to me it's not like fully permissionless. Like there is a paper talking about different degrees of permissionless, and I remember Ethereum is listed as quasi-permissionless, right? So
So
what's your viewpoint on the
yeah,
permissionless definition here?
so first of all, the true permissionlessness, in the sense that it would be cheap and easy to join the system. That is very difficult. That would be very difficult to do. This is originally Bitcoin was such a system, because you could mine Bitcoin in the background of your laptop back in 2009. Laptops in 2009 were different than what the laptops that we have right now. And yes, you could run mining in the background as you were doing other things, because it wasn't very computationally intensive. Now, what is going to happen is that every blockchain every permissionless blockchain that is going to allow for safe transaction of certain amount needs to make it costly to actually add to mine, right? Because the security guarantee of a blockchain is that for the attacker, it will be too costly to double spend. But in order for attacker to be too costly to double spend, it needs to be just as costly for the honest miners or validators to participate in the system. Because you cannot differentiate a priori between attacker and an honest miner, or incentivized miner who does not want to double spend. So the cost of the cost of the system will need to be proportional to the secure transactions, the value of the secure transactions that you need to make. So with that, I mean, I know that I went off on the tangent, but really what I wanted to say is that permissionlessness, taken at the definition of the word, is saying that if you fulfill certain obligations that are not identity dependent, nobody can say that you can or cannot participate in the system, or they can kick you out from the system, or they can hold you hostage. Now, this is separate from requirements to participate in the system that could be technical or capital intensive, so they may be expensive. Right? So this is why sure, we can say that it is not truly permissionless, because not everybody can, you need digital literacy, you need to be able how to operate the code, and so on, so on. So this does create barriers.
I see. Yeah, thanks for explanation. I think this makes sense. Yeah.
But at least Ethereum did try not to put a lot of barriers. With proof of stake, it did, because it did not want to deal with a lot of small stakers. Okay, so I already mentioned that we know a lot of things, but there are still things that we do not know, given kind of large literature that we have on the topic. So we don't know whether the centralized routing of transactions and the kind of mempools can survive in equilibrium. Do we have any equilibria where we can have the centralized system operating? And the dominance that we are observing, for example, in Ethereum, is this protocol specific, or is this going to happen for any protocol? Can we design better protocols that are going to prevent this recentralization? And something that was especially intriguing to me is why removing frictions to competition produces more concentration. Why do we have this kind of flipped result? So I'm going to show you a model that I built, where basically I'm showing that removing frictions does not, in fact, level the playing field between different block creators, but it actually amplifies any differences. So it makes the playing field even steeper. Okay?
I think if you press one of the side buttons, the mouse would stop.
No, I think this is how I turn it on.
The side.
Oh, side button. Okay, there are more buttons.
Here.
Oh, no, I pressed something, okay. I think I pressed.
Here, no.
Okay, thank you. Okay, so I actually built a model that is protocol agnostic, because I wanted to ask what is in the basic forces of permissionless blockchain that potentially may be driving these results, and then whether protocol elements are amplifying it or mitigating it. So I'm starting with basics of permissionless blockchain with DeFi capability. So it is important. It's not applying to Bitcoin, but it is applying to smart contract enabled decentralized trading. So what do we have in such blockchains? We have user transaction that either, okay, let me try, okay, just that may go to a public mempool or not, maybe directed to a particular block creator. Then we have block creators that are collecting these transactions, and then they are creating a block and putting it on the blockchain. So this is like the basics. Without that, we are not going to have a blockchain working, right? Now, remember, what I want to point out that the transparency, there was a question about transparency. Transparency is, potentially there, but it is not required. You can have completely private order flow. Okay, what are other basics? We are going to have one block added to the blockchain at a time. And I think in order to get consensus, we kind of do agree. And maybe there are some blockchains that are sharding, or there are all these ideas, but none of them are implemented. So for now, I'm going to say that permissionless blockchain at one block at a time. Now, ordering, selecting, and possibly inserting transaction affects payoffs. So block creators may get different payoffs depending on whether they control, they get the right to add the block or not. And this is coming out of MEV. There is open and contestable competition over ordering. So this basically means that anybody can become a block creator. Block creators have power over ordering of transactions, and they are competing for this right to add the block. Finally, rules are symmetric. The same rules apply to all the block creators, and there is this entry that anybody can come in, so we are not restricting the entry. We're going to end up with centralization and limited number of active block builders or block creators, but this is not by design. Okay, so these are the minimal assumptions that we are going to make in this model, and we are going to show that this competition over transaction ordering does not discipline concentration, but in fact it exacerbates it. So let me now kind of get into the meat of the model. I'm going to have 2 slides on the model. We have in the model, we have our potential block creators. And because this is protocol agnostic, I'm not going to call them anything specific. Those could be builders in PBS. Those could be validators in proof of stake. There could be miners in proof of work. But in each case, block creator needs to choose an effort to compete for the next block. So kind of going back to the question of permissionlessness, this effort is going to be costly. So not everybody is equipped to take on this costly effort, and that by itself already is limiting the permissionlessness. So the question is, how do we define permissionlessness? But here we're going to have free entry. Anybody who will find it worthwhile can come and participate in this competition. So they choose effort E to compete for the next block. And the success probability of winning the next block depends on your own effort and on everybody else's effort in the system. So Now, this effort may be the mining, can be amount of tokens staked. It could be your bid in an auction. So this particular formula is in fact something that is called Talog contest. And basically what it means is exactly the probability of winning is proportional to my effort. If I am putting more effort, I have higher chances of winning. But if everybody else is putting more effort, then I have lower chances of winning. And this parameter A is a very important parameter. This is called decisiveness of the contest in Talog literature. And what it means is that it basically answers the following question. If I am going to put a little bit more effort than anybody else, I'm putting the most effort, but I'm putting just a little bit more effort than the second best guy, am I going to get a little bit higher probability of winning, or am I going to get a whole lot large increase in probability of winning just from this epsilon increase? So here's an example. If it is a proof of work where I have my mining power, if I have just a little bit more mining power than everybody else, than the second next guy, I'm going to have a little bit higher probability of winning the block. But if I am bidding, so mining is basically A equals to 1. But if I am bidding epsilon more than the next best guy, I'm getting the whole block of probability 1. So this is basically A going to infinity. So a little bit more effort gives me whole improvement on the probability. And this parameter is going to play the crucial role. Okay? The whole payoff of the block creator is the probability of winning times the reward from winning the block, whatever they can extract, minus the cost of winning the block, okay? Or at least competing for the block. Okay? I'm going to talk more about these costs in 2 slides. But before talking more about the costs, we basically need to talk a little bit more about the reward and about the traders. So the reward reflects the protocol reward, right? If I'm getting the new coins, and the value extracted from trades. And it could be, whatever trading volume that the block creator is handling. It could be coming from public or private venues. Traders also, they are choosing where to route their transactions. They can either go to the public mempool, where they are trading, their transaction value is V, but it may be in the public mempool can be extracted with the probability tau, or to the extent of tau m. Or they can send their transaction privately to a particular block creator J, and then they can be extracted at the lower level. Maybe they need to pay a fee, or maybe they are still front run a little bit, but the block creator can promise lower extraction rate. But it only makes sense to send it to them if the probability of that particular block creator actually getting their transaction on the block is high enough. Any questions about this setup?
Is this a small Ri? Is it like a constant, or it should be dynamic? Like what's this small Ri? How do you define it?
So Ri is the ability or decision for the block creators to extract value from trades on average. So for example, ability to front run or propensity to front run. Maybe some block creators may front run transactions, but they decide not to do it. So it is both on the one hand, I can take it as ability. On the other hand, I can say that it is a strategic variable that block creators can promise to extract less value than they are able to.
Okay, so this small Ri is basically a reflection about the this one of the creators' ability to extract value based on the trading volume that it is handling.
Yes.
So this trading volume, it's in terms of like the number of transactions or the total like money amount of the transaction?
So in the very so in the end, you do want this, in the end, the trading volume is actually the value of transactions, because if you're thinking about MEV, large value transactions are going to be more likely to be front run than small value transactions. But so you do want volume. The way I handle it in the model, I'm not going to show the whole model, but just to be transparent about it, I'm going to say that every trade has exactly the same value, and it's just a matter of how many trades they are going to attract. But in the end, it's like they are extracting some proportion of the value of trades that they are handling.
I see. Is it true that the value you can extract is linear towards the total trading volume you're handling, or is there any specific strategy regarding like different pattern of the transaction or like a different purpose of the transaction?
So it doesn't have to be, it does not have to be linear per se. It just has to be increasing. Linear is convenient, but it's not crucial. It's a very, very good point. Some transactions are more likely to be front-run than others. It depends. For example, if we're talking about MEV, it depends on the acceptable spread. Then it's going to be, if you have a large acceptable spread, you are going to be front-run, you are going to be sandwiched much more than if you have lower spread. If you are sending large transaction, you are going to be sandwiched and front-run much more. So not every transaction is just as equally likely to be front-run or to be extracted. So this is kind of on average. And not every block creator has the same ability, right? In order to extract more value, you actually need to run more simulations. Do you have the capacity to run all these simulations to see what is the highest extractable value that you can get?
Okay, great. Thank you.
But what is important is that this RI doesn't need to be linear, but it is individual to a particular block creator. Block creators differ in their ability to extract value.
Yes.
Right, so I'm going to operate on the large RI basis from now. Only one other place small RI is going to show up, but this is basically where it's coming from. And RI, large one and small one, is specific to a block creator. So, first mechanism is explaining exactly, going to the point of the last question, is explaining why RIs are different for different block creators, and they come from MEV. Here I don't need to explain the sandwich attack and where MEV coming from, but what is important is that different block creators are going to have different ability or willingness to extract this value. So going back to the question about transparency is not required. We know that that sandwich attacks and front running is happening in traditional markets where we do not have transparency. Transparency, however, makes it more likely for the transaction to be front run or sandwich, because now it's not only the processor, the broker who is entrusted with transaction that can be misbehaved, but anybody can see the transaction, anybody can sandwich it. But even though transparency equalizes information, it is not equalizing the ability to profit from it. So this is the basis for our assumption that RIs are differing between block creators. And this is, by the way, something that Bitcoin or Ethereum design did not really accounted for. Okay, so let me go back to and say a couple more words about this model and talent contest before going into the two other mechanisms, which are the main driving force. So like I said, the success probability is given by this ratio. And this parameter A is very important. I do want to mention something about the cost. So the cost of effort is in fact three, like I decompose it in three parts. One part is the cost that you are bearing of your effort, no matter whether you win or not. So this will be when you are mining, whether you win or not, you are paying the cost of mining. Then you may be bearing the cost of your effort, but only if you actually win. And the third part maybe you're paying only when you win, but you're paying something that depends on everybody else's effort. So why do I decompose it in these three parts? And there are some assumptions on those parts. I decompose it so I can, in fact, have many different environments falling into the same model. So for example, like I said, proof of work and proof of stake are going to have A equal to 1, the cost of mining or staking, and alpha and beta and gamma being 0. But we can have all pay winner take all auction, where A is infinity and we're paying whatever we bid. We can have first price winner take all auction, and this is where we pay what we bid, but only if we win. Or we can have second price, and this is when we pay only when we win, but we are paying something that is based on other people's bid. And you can basically, this way, with this cost function, you can fit almost any environment that you can imagine into this tallow contest with generalized construction. Okay? So this is pretty cool. I actually think that we are not using tallow contest, as much as we should. It's explaining a lot of things, so it could be used more often. And it gives us very clear results for the mechanism, what I call mechanism number 2. And this is because each round we are going to create one block. The winner is going to receive the reward. The reward differs depending on who is the winner. And agents exert effort. The probability of winning rises with effort share. First of all, what we are seeing is those who have higher ability to extract value, they have higher reward from winning a block, they are going to exert more effort, and they're going to get higher share of the blocks created. Okay, so those who are extracting more, they're going to get higher share. So going back to this argument why builder-proposer separation should work, well, this is why it shouldn't, but nobody really looked at the tallow contest. Okay? Second, contests differ in decisiveness. Is what I mentioned. If we have diffuse like proof of work or pure proof of stake, and you can have auctions which are very decisive, like builder-proposer separation. Now, what happens then? Ask if we hold everything else the same cost, the same R's. If the contest becomes more decisive, the same differences translate into larger differences in the probability of winning the block. Okay? So what happens if we have increasingly clean and decisive contests? It is like actually should be slash. If we're moving from proof of work and pure proof of stake to PBS, small differences become large outcome gaps. So the argument was we are going to decentralize by moving to PBS. But if you look at this, no, it was like you would know right away that you're going to in fact centralize. Okay. And then we have a third mechanism. And this is where traders' response to this is making things worse. So, like I said, if trader sends the transaction to public mainful, runs an extraction risk. If that extraction risk is too large, then traders route privately to a particular block creator, but then they will want to route to the block creator that offers it, first of all, promises not to extract too much value, but only block creators that have high probability of including the block are worthwhile to consider. So traders will have preference for block creators with higher inclusion probability. So a block creator that has more private order flow has more transactions that is processing, more value that is extracting because it has more transactions to process, that allows the block creator to have higher inclusion probability because it's higher R. And that higher inclusion probability is attracting even more private order flow, because now it is like if I want to route to one, then I want to route the most popular one. And those would be the ones that are extracting most value. So ironically, traders are going to individually select the block creators who are extracting more value because they are most effective in putting their block to the blockchain. So it's up to the, and I don't do a full analysis here, but it's up to the block creator to balance the extraction value with probability of, with inclusion probability. But either way, the block creator with the highest ability to extract value has the highest leeway to both extract value and have higher probability to give enough of the surplus to the user trader. So with this feedback loop, which some may call network effect, because everything is about network effects, the market sharing is unstable, and everything tips to a monopoly sooner or later, right? It's a dynamic setting, but sooner or later, this market is going to tip. And even if you allow multi-homing just slows the process down, but does not rescue decentralization. Okay, so let me put it all together. Why do blockchain markets centralize? So those are permissionless blockchains, and we're talking about trading so that the value is extractable. Because in pure Bitcoin market, you don't really have these differences in ours. So first of all, payoff relevant ordering, together with different ability to extract value, produces the differences in the reward for the block creators. Once we have differences in the rewards, then the contest is going to sort the block creators and is going to give those who have higher extraction ability larger share in the blockchain. Decisiveness of the contest is going to exacerbate it. If we're going to have more decisive contests, right, moving to auctions, is going to amplify these differences and is going to increase concentration even further. And on top of that, the traders themselves are going to prefer to route to the block creator that has the highest probability of including the block in the blockchain, which are the ones who have the highest reward from putting the block on the blockchain, which are the most extractive. So why, in view of that, why Ethereum's decentralization updates backfire? Well, transparency makes payoff relevant opportunities predictable, so it makes it more predatory, to allow more predatory. Proof of stake made private order flow more appealing, exacerbating the third part, because with mining, like you didn't know which one is going to win. With proof of stake, it's easy. I know exactly who is going to win before they are actually going to win. I mean, because they are announced before the block is put on the blockchain. Auctions made contests more decisive, amplifying the small differences, right? And the specialization of builders amplified the heterogeneity in the first part. Okay? So I also just kind of say one word that this is not a blockchain anomaly, and we are seeing that kind of going back to where else do we see that? That this is basically the same forces we see in the internet economy, where in principle, it's a permissionless environment. Anyone can come in and create a search website, a shopping website, job matching website, and so on. And yet, because this ordering matters and the ability to monetize on this ordering also is different by different providers, we see exactly the same dynamic leading to very few winners in the market and centralization. So let me stop here. Thank you very much. Yeah, I mean, 5 minutes if there are any other questions.
getting going?
Oh, well, thank you. This is very cool modeling, and I think it's really blown my mind. So, like, just coming back to your last point here. So, do you expect, when like the recent blockchain developments, we are increasing the throughput in a significant magnitude? So when the block is created much faster, and now like the block space is no longer like a scarce resource, do you think this will help solve the MEV problem and becoming leading the blockchain to a truly economically decentralized system?
Okay, so let me kind of turn this question around. And I don't know whether you're familiar with high frequency trading, but the question is, did the high frequency trading increase profits of the high frequency trading companies or decrease it?
Yeah.
It increased. It increased. Yes. So basically, what happened is that you actually, I mean, there's more competition, but the point is that making the wheel spin faster is not changing the fact that you have one block at a time, and being quicker is valuable. So now, before in Ethereum, you could not be quicker than 12 seconds. Now you can be quicker than 3 seconds. It's still better to be in the first block than in the second block. And it doesn't matter whether it's scarce. I mean, it's always going to be the space is always going to be scarce per block, because otherwise you're losing on other dimension of decentralization. If you have a lot of either large capacity of the block, or you have short intervals, then you are not going to get it's difficult to get the consistency of the system because of the latency. So either you're eliminating those that are slower and have lower storage, and then you're losing permissionlessness, going back to the point of, is it permissionless? Or you are still going, it's still going to matter whether you are faster or like you are second or first or second or third. Just like, in the block, it actually matters whether you are in the beginning, you have the priority transaction, or you're in the main body of the block. So in fact, no, I don't think this is going to make much of a difference.
That okay. Yeah, because I understand from the high frequency trading points, like if you but basically like those companies are still earning those friction from those like early position. But when like first like a blockchain, there is no centralized server that's next to NYSE, right? And secondly, like now like those fast blockchain can reach performance very close to like the network delay, like one round trip. So this, from my understanding, is that it's now, from the practical standpoint, it's impossible for you to even do any analyze and insert related transactions to extract MEV. There may be like new ways to generate MEV in this sense, but just from the current my current understanding is basically from the network delay perspective, it does not even give you the possibility to do that. So are you saying that so maybe the current version of MEV may be somehow eliminated by like fast performance blockchain, but there could be some other new kinds of MEV that's emerging from this decentralized system?
So the fast blockchains are still slower than high frequency trading. And if high frequency trading can analyze and optimize the position on the trading, so it can be done in blockchains. It may be that only for some of the transactions and not others. But as long as it's going to matter whether you are this second or next second, then you are going to go to you're right, there is no centralized server. This makes the dominant block creator more powerful as a proxy for centralized server, because the most dominant block creator is more likely to get the next block.
Yes. Yes.
So what it does, where it matters is the overall transaction fees. if you pull down the limit on the overall blockchain throughput, it is going to lower overall transaction fees. But it's not going to lower the extraction, maybe lower, but it's not going to eliminate extraction possibility from the blockchain.
I see.
So let's thank the speaker again.
Thank you.